An initial public offering, or IPO, marks a significant milestone in a company's journey. It signifies their transition from a privately held entity to a publicly listed one. By offering shares to the public, companies aim to raise capital for expansion, debt reduction, or other strategic objectives. For investors, IPOs present an opportunity to buy into a company's growth story at an early stage. Think of an IPO as a company's grand debut on the stock market. Before an IPO, shares are held by a limited group of investors, often founders, venture capitalists, and early employees. The IPO opens the door for anyone to become a shareholder. This influx of capital fuels the company's future endeavors. The Indian stock market, comprising the National Stock Exchange and Bombay Stock Exchange, has witnessed a surge in IPO activity in recent years. Companies across diverse sectors are leveraging the public markets to fuel their ambitious growth plans. This presents a plethora of investment opportunities for those seeking to participate in India's economic expansion. However, IPO investing requires careful consideration and due diligence. Understanding the dynamics of the IPO process, regulatory framework, and potential risks is crucial for making informed investment decisions. Before embarking on your IPO investment journey, it's crucial to ensure you have the necessary accounts and documents in place. These prerequisites streamline the application process and facilitate seamless transactions. Firstly, a demat account is indispensable. Similar to a bank account holding your money, a demat account acts as a repository for your electronic shares. Opening a demat account is a straightforward process, typically offered by banks and brokerage firms. Next, a trading account linked to your demat account is essential for placing buy and sell orders in the stock market. This account serves as the interface between you and the stock exchanges, enabling you to participate in IPOs. A PAN card issued by the Income Tax Department of India is mandatory for all financial transactions, including IPO applications. It serves as your unique identification number for tax purposes. Lastly, ensure you have a bank account linked to your demat and trading accounts. This facilitates seamless fund transfers for IPO applications and subsequent trading activities. Having these prerequisites in place will ensure a smooth and hassle-free IPO investment experience. The IPO application process in India has been streamlined with the introduction of the application supported by blocked amount (ASBA) facility. This system ensures that funds are blocked in your account only if you are allotted shares, eliminating the need for refunds and minimizing paperwork. Here's a step-by-step guide to applying for an IPO through ASBA. Identify the IPO you wish to invest in. Carefully scrutinize the company's prospectus, financial statements, and industry outlook to assess its growth potential and risk factors. Most banks and brokerage firms offer online ASBA facilities through their websites or mobile applications. Log into your account and navigate to the IPO section. Select the IPO you wish to apply for and provide the necessary information, including your demat account details, the number of shares you wish to bid for, and the price you are willing to pay. Review the application details carefully before final submission. Once submitted, your bank will block the corresponding amount in your account until the allotment process is complete. While online applications are increasingly popular, offline applications are still accepted by some brokers and banks. Obtain a physical application form, fill it out accurately, and submit it to the designated branch along with the required documentation. Once the IPO subscription period closes, the allocation of shares takes place. This process is usually completed within a week or two after the IPO closes. The allotment is done based on the number of applications received and the shares available. If your application is successful, you will receive an allotment letter from the registrar of the IPO. This letter will specify the number of shares allotted to you and the price at which they have been allotted. The blocked funds in your account will be debited to the extent of the shares allotted. Following the allotment, the company's shares will be listed on the stock exchanges, the NSE and BSE. The listing date is typically announced in advance. Once listed, you can track the performance of your shares through your Demat account or trading platform. You are free to hold your shares for the long term or sell them in the market depending on your investment strategy and market conditions. It is important to note that IPO prices can be volatile in the initial days of trading. Factors such as market sentiment, company performance, and industry trends can influence the stock's price movements. Section 5. Tax implications of IPO gains. Short-term versus long-term. Understanding the tax implications of your IPO investments is crucial for effective financial planning. The tax treatment of capital gains from IPOs in India depends on the holding period of the shares. Short-term capital gain. If you sell your IPO shares within 1 year of allotment, the profits are considered short-term capital gains. These gains are taxed at your applicable income tax slab rates. Long-term capital gain. If you hold your IPO shares for more than 1 year before selling them, the profits are classified as long-term capital gains. Long-term capital gains from listed equity shares are taxed at a rate of 10% if the gains exceed Rs 10,000 in a financial year. It's essential to maintain accurate records of your IPO investments, including the date of allotment, purchase price, and selling price. This documentation will be helpful while filing your tax returns. Consulting with a qualified tax advisor can provide personalized guidance on tax optimization strategies for your IPO investments. Section 6. Repatriation of funds. Navigating the regulatory landscape. For foreign investors participating in Indian IPOs, understanding the regulations surrounding fund repatriation is crucial. Repatriation refers to the process of converting local currency, Indian rupees, back into your home currency and transferring it out of India. Non-resident external (NRE) accounts. Funds held in NRE accounts, specifically designated for foreign earnings, are freely repatriable. This means you can transfer the funds back to your home country without any restrictions. Non-resident ordinary (NRO) accounts. NRO accounts are used for depositing income earned in India. While you can repatriate funds from an NRO account, there are certain limitations. The current regulations allow for the repatriation of up to $25,000 per financial year from an NRO account. Prior permission for higher amounts. If you need to repatriate funds exceeding the specified limit from an NRO account, you'll need to seek prior permission from the Reserve Bank of India, RBI. This typically involves providing supporting documentation to justify the repatriation. It's recommended to consult with your financial advisor or tax consultant to understand the specific regulations and documentation requirements for fund repatriation based on your residency status and account type. Section 7. Key considerations for prudent IPO investing. While IPOs can offer lucrative opportunities, they also come with inherent risks that require careful consideration. Here are some key factors to keep in mind before investing in an IPO. Thorough company research. Conduct in-depth research on the company's business model, financials, management team, industry dynamics, and competitive landscape. Understand their growth prospects and potential risks. Valuation and pricing. Assess whether the IPO price is justified based on the company's fundamentals and future earnings potential. Compare the valuation with industry peers and consider market sentiment. Understanding the risks, IPOs are inherently risky investments, especially in the early stages of a company's public life. Factors such as market volatility, competition, and execution challenges can impact stock performance. Investment horizon and goals. Determine your investment horizon and align it with your financial goals. IPOs are generally considered long-term investments, and it's crucial to have a realistic expectation of returns. Diversification is key. Avoid putting all your eggs in one basket. Diversify your portfolio across different asset classes, industries, and companies to mitigate risk. Remember, IPO investing requires careful due diligence, a thorough understanding of the company and its prospects, and a realistic assessment of risks. Conclusion: weighing the potential and risks of IPOs. Investing in IPOs can be an exciting avenue to participate in a company's growth story from its early stages. The Indian stock market offers a plethora of IPO opportunities across diverse sectors, providing ample avenues for potential wealth creation. However, it's crucial to approach IPO investments with a balanced perspective, acknowledging both the potential rewards and inherent risks. Thorough company research, careful valuation analysis, understanding the regulatory landscape, and a long-term investment horizon are essential ingredients for successful IPO investing. By staying informed, conducting due diligence, and seeking expert guidance when needed, you can navigate the world of IPOs with confidence and potentially reap the rewards of investing in India's burgeoning economy. Happy investing! Disclaimer: navigating the inherent risks of investment. The information provided in this essay is intended for general knowledge and informational purposes only and does not constitute financial advice. Investing in the stock market, including IPOs, involves inherent risks, and the value of your investments can go down as well as up. Before making any investment decisions, it is essential to conduct your own research, consider your financial circumstances, risk tolerance, and consult with a qualified financial advisor. The author and publisher of this essay shall not be held liable for any losses arising from investment decisions made based on the information provided herein.